Hi everyone, it's Shafman from Shafman TV. I'm just talking today about what a margin of safety is and why it's important. Now, margin of safety derives from a book called The Intelligent Investor by Benjamin Graham, a book I strongly advise any person who wants to invest or is interested in investing reading. It's really an important book, in my opinion. And there is a chapter there relating to what a margin of safety actually is. Now, a margin of safety, in order to know what a margin of safety is, you need to have some sort of basic accountancy skills, i.e., you need to be able to value as a whole what a company is worth and to look at the company's market capitalization. Now, if you're not sure what those terms mean, just Google them. But the market capitalization is basically all of the share capital which is issued and the current share price multiplied, and that gives the market's capitalization, and it's basically the value. It's basically what you'd have to pay if you wish to buy the whole company. Now, back onto my previous point about a margin of safety, that essentially you would then, once you knew what the market capitalization was, you would then need to look at the actual company's statutory accounts. You'd have to look at the balance sheet, you'd have to look at the cash, the debt situation, the pension liabilities, the lease liabilities, any type of liability or any type of asset, and then you would make a value judgment about what you thought the whole company was worth. So, a very simple example I can give you is that a company has £100,000 cash. It has a building worth £100,000, no liabilities at all. Then, very simplistically, that company is worth £200,000. If the same company had a liability, a mortgage, for example, of £50,000, then the company would be worth £150,000. So, why is that important? It's important because we compare, well, what is called the liquidation value of a company to its market capitalization, because we basically want to know whether we're getting value for money and also whether there is a margin of safety. Now, the margin of safety is the difference between the market capitalization and the actual liquidation value of a company. So, in the previous example I gave, let's assume that the company has £100,000 cash, £100,000 building, for example, and £50,000 mortgage, and no other liabilities or assets. That company is basically worth £150,000. However, if that company was traded on the stock market and its market capitalization was, say, £75,000, you've got a margin of safety there of £75,000. Or if it was traded on the stock market at, say, £100,000 market capitalization, you essentially have a margin of safety of £50,000. Okay, now I'm giving a very, very, very simplistic sort of examples there, but what I'm trying to illustrate is that in that scenario, you're essentially paying less than what the intrinsic, what the actual value, the liquidation value of the assets of the company are. Now, there could be a myriad of reasons why you're paying less, and some of them bad, some of them good, positive, negative, whatever. But the whole point of a margin of safety is to protect the investor against overpaying for assets, i.e., overpaying for stocks or overpaying for anything, for example. So, again, this feeds into something which Buffett says, which is that price is something you pay, value is something you get. So, price is something you pay, and value is something you get. So, Also, another additional point is that generally speaking, operating with a margin of safety protects you against a capital loss. And it is synonymous with value investing, and there is a lot of data to show that value investing over a long period of time generates very favorable results. And this is what Buffett did in his cigar butt phase at the start of his investment career, where he would pick up companies with a margin of safety which were basically trading below their actual liquidation value, and would pick them up. And as he famously said, he took one last puff from the cigar and essentially managed to make a profit on that, on those things. And this is obviously pretty common also with some activist investors who look to buy into a company where the market capitalization is less than what I will call the liquidation value. And once the activist comes on board, they look to remove management in many cases, and they also look to liquidate the company and make a profit that way. So in our example, if the activist investor is paying sort of, 50 pence in the pound or 50 cent in the dollar, then they'll look to liquidate the company and actually double their money that way. So the point is that a margin of safety is a really important thing, and it feeds into your wider ability as an investor to place independent valuations on assets, to look at assets, illiquid assets, liquid assets, cash, bonds, whatever, other investments that a company's made, property, machinery which is maybe depreciating or is being amortized, intellectual property, and make an analysis of the company's assets and try to pay less than it's worth. And that margin of safety is your insurance policy against loss. So it's really important that if you are going to buy a house, if you're going to buy a commercial property, it's very difficult with property, to be honest with you, to actually know what a margin, to actually know what the liquidation value is. But generally speaking, it's going to be resale value. What I would personally like is resale value in an average market or a depressed market. And also, this obviously, if you flip it on its side, overpaying, having a margin of safety should stop you overpaying for stocks or overpaying for assets. And this is also part of, in my opinion, a big problem for investors, where they get caught up in what John Maynard Keynes described as animal spirit, and assets are going up, I must buy, I must get in now, it keeps going up. And this is where investors lose money, because they overpay for assets. They pay too much. Price is something you pay, value is something you get. You want to squeeze out as much value as possible and get as much bang for buck, as much for your cents and dollars and pounds as possible. And having a margin of safety gives you that. It gives you the mindset to try and pay as little as possible for assets. And it also gives you a very good insurance policy, because it's not foolproof, but if you've got a diversified portfolio and you've got a margin of safety, because maybe the stocks are unfancied or out of favor or whatever, then generally speaking, over a long period of time, you should see a pretty good investment return, as opposed to chasing hot stocks. And this is really a big mistake for investors. Every week, every month, over trading hot stocks. Oh, it's gone up 20%, I'm going to buy some. And they're constantly chasing, fashionable hot stocks, and, companies that are, have some type of, favorable press release, or companies that are, in vogue at the moment, for example. And it really isn't a good idea. Trust me, it's not a good idea. And a margin of safety with anything that you buy, any assets, will set you in good stead. So I advise all everyone to go and have a look at the Intelligent Investor and just have a scan of the chapter on margin of safety. And it also touches upon the vicissitudes of the market and how the market can go up and down and this sort of volatility. But if you have a margin of safety, it should stand you in good stead. So it is extraordinarily important, and I can't overstate the importance as well of this. So I hope that was useful. Thanks, guys. Have a great day. Thank you.